Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We got 1 hour to go until the market closed, so we're taking a look at the major averages. And once again, we have red, but red that is now turning upward, at least when it comes for the Dow. 178 points or so is what the Dow is down currently, but we're seeing this trajectory move upward, and that's because, let's play out a little timeline for our viewers here. This morning, President Trump had posted on social media that because of electricity imports that Ottawa Premier Doug Ford was going to impose on electricity coming to the United States, that we were going to impose steel and aluminum tariffs of 50% effective tomorrow. Well, now reportedly, Ford and Howard Lutnick, the Commerce Secretary, have spoken on the phone, and Ottawa has removed those electricity tariffs. So now, I don't know, a little bit of a better headline on tariffs, I guess?
You just kind of seem to be following the bouncing ball of tariff headlines.
Yeah.
Because to your point, Julie, it's been a volatile session. I mean, if you woke up early this morning, you actually had green on the screen. And then, to your point, you gave all that up because we had new headlines, new fresh tariff threats, right? Talking tough on Canada. So again, you're back to investors trying to figure out, wow, what does that mean for the U.S. economy? Does it mean a slowdown? Does it mean something worse? But now new headlines said, okay, we have a conversation, we're talking, and we get a bounce.
So in other words, just to sum up, that's the idea, and that's the movement that we've got. And the NASDAQ is doing the best of the three major averages, and it's worth pointing out here that a lot of the heavy lifting being done to the upside today is being done by large cap technology. So the index is doing the best, and it also helps to contrast the S&P 500 up barely with the S&P equal weight, which is still lower. So that weights all of those 500 stocks equally, and again shows that these more heavily weighted big cap tech stocks are doing better. You can also see it, of course, when you look at a board of the large cap tech stocks. Here's the NASDAQ 100. Apple and Alphabet still in the red, Alphabet just barely, but then you've got a recovery, particularly in Tesla we've been watching today. There were people sort of watching for the bottom in stocks broadly, but in Tesla specifically, because of the big downturn that we've seen in the stock, down 42% this year, and today, that bounce looks awfully little when you look at the year to date, but it is indeed a bounce that we're seeing today.
You see this bounce when we talked about, Julie, we're going to talk about more on the show. I mean, big tech has just taken such a big hit. I thought our colleague Joshua Schaefer, with a great piece today, talking about how, yes, this souring in the market, we should certainly, and of course, do talk about Trump tariffs. Josh also talking about this kind of souring, though, in that mega AI trading trend, how investors don't want to seem to bet as big here, clearly on future AI growth. If you lose big tech, strategists will be quick to point out you don't really have a net under you unless you believe that baton gets quickly passed.
Well, today, big tech is carrying everything else, right? XLK is the only group in the green, as
Bounces
we mentioned. Although we're seeing, XLC, which is communication services, down. Staples doing the worst with industrials. But of course, if you flip this over to the year-to-date look, you've got XLK down 9.5%, along with consumer discretionary. So to the point of whether that AI trade has rolled over.
Yeah. All right, let's get more on this. One of the latest market moves. Let's welcome in Dryden Pence Capital Management CIO. Dryden, always good to see you and have you on the show. So listen, we were just talking there. We got a lot of headlines today, Dryden. I got geopolitical headlines. I got new, fresh tariff threat headlines. What are you making it of all? What are you telling your clients?
Well, the first thing I try to tell people is that we're more interested in bottom lines than we are headlines, because as you all just talked about, the headline can change from morning to night and move the market. But what we're really trying to look for is long-term, earnings growth, long-term delivery of profitability for clients and wealth creation. So as I say many times, I'm more interested in bottom lines than I am in headlines. And while they can create volatility, they don't always create wealth. And that's what we really want to try to focus on.
Dryden, I guess the problem now is the headlines are affecting the bottom lines, or they're starting to, right? Because now we've heard from everything from Walmart to the airlines now to Verizon talking about a softening consumer. Now, whether that softening consumer is because of they're watching the news or because there's underlying stuff going on in the economy, regardless, we are seeing more companies warn because of some of these concerns. So what do you do with that, I guess?
Sure. Well, part of this is you almost call it the tariff tantrum. People are worried about tariffs. It creates uncertainty. And then you have companies and CFOs, they really don't know what the long-term prognosis is going to be. And I think that level of uncertainty does work its way into companies' own projections. But I mean, if you think about it, earnings are still good. 75% of the companies are beating earnings. It looks like that there's only been a minor revision in what the earnings for the S&P 500 are for the entire year. So I think that there's sometimes this concern, at least to us, seems a bit overblown, but it is beginning to affect people. But I think it's very important to remember that while you worry about the tariff talk and you worry about all these things, 4 out of 5 jobs in the United States are really service related. 2/3 of the economy really doesn't have much to do with international trades. And so it's not a one-to-one relationship between the tariffs and how it ends up with the individual consumer or individual prices. So we probably are at risk of overreacting at a time like this. And I think that that's an important thing for everybody to remember. And besides that, this is now, these conversations begin to be a catalyst for something that's a normal occurrence. The S&P 500 goes down around 10% every 13 months or so. Well, now we're at month 17, so we were due for a significant pullback, and we've had it, right? So now we've had this correction. You're seeing this little bounce off of this. This is kind of the normal battle rhythm of the markets. This one's different, though, because as we were concentrated on the Magnificent Seven going up, we're somewhat concentrated on the Magnificent Seven going down. If you look at the equal weight, or the 493, we've talked about this before, they're doing reasonably well in this environment. Obviously, today is a little different because the bounce is led by who's been hurt the most. But if you look at so far this year, if you look at the S&P 500, the equal weight is flat or very close to flat, whereas the cap weighted is down 4 or 5%, or is now down almost 10%. So you're seeing this better performance in the 493. A lot of this was leveraged to the Mag 7, and I think it's a matter of waiting for this to balance out.
So given that broad view, Dryden, when you sound relatively constructive, would your view be then, listen, if there's a sell-off, that's an opportunity?
Absolutely. I think you want to take advantage of volatility, not be its victim. I think if you really focus on earnings and you focus on fundamentals, you can see this headline overreaction to many things is really just giving opportunities. It's like that Kipling poem, right? If you can keep your head when everybody around there is losing theirs, I think that makes a good sense here.
And so what have you been adding to as this sell-off's been going on, Dryden?
Sure. One of the things that we've looked at is infrastructure. Infrastructure got really hurt because everyone was worried about what was DOGE going to do? Are we going to have big cuts in federal spending and things like this? And while the government is going to cut back on some inefficient spending in infrastructure, they're going to continue on roads and bridges and things that have a positive multiple that are efficient. So we looked at companies that have been severely beaten down by, we think, this overreaction. And so if you think about a couple of them, you've got United Rentals, you've got Jacobs Solutions, and you've got AECOM. All of them are really tied to repairing roads and bridges in this country, and that's something that we have to do. Congress has already authorized over $500 billion to spend this. We need about $1.2 trillion going forward, but these investments are things that help propel our economy forward, and those are things that we're going to continue to spend on. And besides that, Jacobs and AECOM have contracts with Ukraine. We just have word of a truce coming out, so they're going to have to rebuild that country as it comes. So you're looking at those three entities that are really kind of right in what I call the choke point. You pretty much have to use those companies if you're going to do a lot of road and bridge repair, and we have to do that in this country, and that's one of those things that we're going to continue to spend money on, and it's already been allocated. So I think that you have a lot of long-term profitability in those companies. They've been beat down. I mean, they've really been beaten down, and more of an emotional thing, but their PE ratios are pretty decent, and we think the long-term prognosis for those three companies going forward is good. So this is one of those moments where you kind of look at them and say, am I a long-term investor, and is this an opportunity created by volatility as opposed to something that I want to be victimized from?
Dryden, thanks so much. Good to see you.
Absolutely. Thank you. Great to see you all.
We are tracking the fast-moving developments in the trade tensions between the U.S. and Canada. Just hours before President Trump's 50% tariffs on Canadian steel and aluminum go into effect, Ontario Premier Doug Ford announcing he is suspending the surcharge on electricity exports. Yahoo Finance's Ben Werschkel's here, tracking all of the back of the and forth. Heads are turning like a tennis match here as we try to stay up to date with it, Ben. So what is the latest?
Yeah, the latest is the big thing is what you said just about the Ontario Premier limiting the electricity surcharges for now. What's not in that statement that just came out a few minutes ago is any word on Trump's charge for these 50% tariffs. This is something he moved on this morning. He's long planned to do 25% tariffs on steel, aluminum starting tomorrow. He upped that on Canada, which is the major importer of both of those products, for tomorrow morning to 50% this morning. And now we've had this back and forth with the Ontario Premier and the Commerce Secretary, but we don't officially have word yet on what's going to be the fate of those tariffs. Trump announced those tariffs based on this idea of an economic electricity emergency. So this would seem to take that away, but we don't know for certain yet. He would presumably have to sign a new kind of declaration of emergency to impose those. So he could back away from those before this midnight deadline. Either way, the 25% deadline, the 25% tariffs are set to go into effect. Those are a different tariff authority. Those are based on an executive order he signed a few weeks ago that, unless he changes his mind there, would go into effect no matter what.
There are some other headlines, Ben. I'll just bring them to you. Dropping on this, Trump. It's looking at backing down on the 50% duties on Canada. May back off doubling steel, aluminum, Canada tariffs. Will probably make a different tariff decision. I will let you know. So what do you make of what do you make of those headlines?
That's exactly. It's changing by the moment here. I gather this is from. He's speaking to. He's appearing with a Tesla right now as we're speaking to buy a Tesla from Elon Musk to show his support from him. So I think he's taking questions from reporters. Yeah, it sort of points to a larger point here that everything is negotiable at every moment, and so he's kind of going back and forth on this. I think the big drawdown would be if he backs away from the steel aluminum tariffs. What I wrote about today was how actually the steel and aluminum CEOs, a lot of them really are supportive of this. They've been yelling for more protection for years now based on Chinese steel dumping. So he actually has support for certain levels of steel and aluminum tariffs, kind of going big and upending markets even further, obviously, goes against that for him.
Yeah, and it's unclear whether he's talking about getting rid of all of those steel and aluminum tariffs now before they're supposed to go into effect tomorrow, or go back to the 25% level he talked about. As he said, I'll let you know. And as he has been, moment by moment. Meanwhile, Ben, the president is also set to meet with some of the country's top business executives tonight, folks from the Business Roundtable. What do we know about that meeting?
So that meeting will be at 5 o'clock tonight, so just in a couple hours' time. He's going to go to the Business Roundtable's office. Business Roundtable is a group, for people who don't know, it's the sort of voice of CEOs in Washington, D.C. There's over 200 of America's top CEOs are members. Over 100 are expected to be in attendance this afternoon. And as we've been talking about this whole time, the kind of what we're expecting, or what I'll be watching for most specifically, is anything on tariffs. You know, every one of these speeches, the question is whether Trump is going to offer any give on tariffs. He clearly is going to comment on these probably one way or the other, but the signals obviously from him and his team today are that they're not backing down from the kind of larger point of their tariffs, which is, I think, what the CEOs, it'd be fair to say, want to hear, is a sort of some give on tariffs. He's going forward with his April 2nd reciprocal tariffs, no matter how much goes forward today, and sort of wants to set up a pretty giant tariff agenda. The question is whether he kind of gives anything to the CEOs in attendance who kind of want some wiggle room, especially folks like Jim Farley, who's the CEO of Ford, who's really wanted some limits on that, and Trump hasn't been giving it so far, other than delays.
Right. Yes, exactly. Well, we'll see what ends up happening tonight, or in the next couple hours before tonight. Thank you so much, Ben.
Good thing.
Well, as President Trump has escalated those trade tensions with Canada, remember he shared the post on Truth Social, his plans to boost those Canadian tariffs on Canadian steel and aluminum. But now we are getting more information that is not necessarily the case here. The trade war really has that steel and aluminum industry directly in its sights, but some in that industry are actually in favor of these tariffs being put on. Here to discuss, Steel Manufacturers Association President Philip Bell. So, Philip, you're pretty much hearing all of this as we are hearing it in terms of the latest developments. If indeed the president is now going to say, never mind, we're not doing these steel and aluminum tariffs, whether it's with Canada, whether it's overall. Just give us your reaction, I guess, to what we're hearing.
Well, we support what President Trump is doing with the tariffs. We feel that this is a central piece of his America First policy, Julie, where he is putting our economy, our national security, steel workers and their families first in order to have fair and even trade. Keep in mind, the steel industry has been under assault for decades with highly subsidized dump steel from China and other bad actors. And I think this is an important step to make sure that our trading partners like Canada and Mexico don't aid and abet the bad actors. So we'll wait and see when the announcement becomes official tomorrow. It's my hope that he sticks with at least the 25% tariffs as he originally planned.
Philip, if the aims of the Trump administration, let's say broadly, if they're to protect domestic steel and aluminum makers, if they're boost production, create more jobs, do you think the levers, the tools they're pulling here, Philip, are those the right ones?
Josh, I do. If you recall, during the first Trump administration, when he put the 232 national security tariffs in place, that spurred a lot of steel industry investment to the tune of about $20 billion to modernize, decarbonize, and electrify the steel industry. So it became more efficient and more competitive. So I do think these are the right levers. Also, what this will do is it will get pricing back to market levels so that they're not artificially low due to market distorting practices by China and other countries. So I do think these are the right levers.
Is the industry ready to increase its production then to make up for any shortfall that's going to happen as a result of not getting perhaps as many steel imports, right? Because is there concern within the industry about prices falling if you all make too much?
No, that's a great question, Julie, and the industry is ready. Right now, the United States is in a situation where it does not have enough domestic steelmaking capacity to meet domestic demand. Hence, we constantly have this 15 to 20% overhang of imported steel. Now, as long as those imports are traded fairly, that's not the issue, but often they're not. So there's plenty of new capacity coming online. And right now, capacity utilization is in the low 70% range. So there's a lot of room for growth.
What about, Philip, those are going to say, higher prices mean higher input costs for a range of those other industries, right? Construction, manufacturing, transportation. What's your response there?
Well, Josh, my response there is when you have a narrowly targeted tariff on one product category like steel, that rarely has this widespread effect on overall inflation. In fact, when you look at steel-intensive manufacturing products like automotive, a 25% tariff on steel during the first round of tariffs only increased the price of a $40,000 car by about 1% to 2%. There are a variety of other inputs, such as semiconductors, rubber, plastic, and composites. There's labor cost, there's shipping and logistics cost, and then demand drives pricing as well. So we don't think a targeted tariff for steel is going to necessarily have that widespread effect.
And what about the we've got the carrot and the stick approach here. This is mostly the stick approach. What about you guys wanting maybe some subsidies for the homegrown steel industry and being able to build out more capacity?
Well, one of the things that we do like are incentive programs, but quite frankly, the $20 billion that has been invested to modernize the steel industry has actually been on the steel industry's own dime. We haven't really relied on a lot of subsidies and things like that to grow our industry. There's a little bit of IRA money out there, but that might be cut in order to pay for the tax extension, the tax cut extension. What we would rather see, though, is what the president has pledged to do, and that's to extend the tax cuts and also create more regulatory certainty and get rid of the regulatory overreach that is even more burdensome on steelmakers.
Philip, thank you so much for your time, and thanks for rolling with all of the late-breaking developments here. We appreciate it.
You got it. Thanks.
We're just getting started here on Market Domination. Coming up, we'll hear from an economist to preview Wednesday's highly anticipated consumer price index data as we get the latest read on the economy. Stick around, much more Market Domination still coming your way. After optimism about a possible soft landing, Wall Street is now considering a different term, stagflation. Who better to break down what that means ahead of tomorrow's inflation reading than Yahoo Finance senior reporter Alexandra Canal. Hey, Allie.
Hey, Julie, that's right. Stagflation fears are now spooking markets. And if you haven't heard that term before, spoiler alert, it ain't pretty. So essentially, stagflation is a bleak economic scenario in which growth stalls, inflation persists, and unemployment rises. Now, we did see a slight uptick in the unemployment rate for the month of February, but it's really the growth story that economists have been focused on in recent weeks. And to that point, we've seen some pretty prominent Wall Street firms slashing their GDP targets for 2025. We have Goldman Sachs now at 1.7%, Morgan Stanley at 1.5%. Previously, they were hovering at just around 2%. So that's a big reason why you're seeing stocks sell off. Now, recent data points have also shown some stagflationary pressures underneath the surface. You take a look at something like year-over-year wage growth. We saw that come in at 4% for the month of February. Now, that is lower from the 4.1% that we saw in January, but still pretty sticky prices, and we've been hovering around these levels for the past several months. And then last week, we saw the prices paid index in the ISM's manufacturing PMI report come in at the highest level since June 2022, while new orders fell, and that data arrived on top of bleak consumer survey results. So it's really just been this consistent drumbeat of pessimistic data points, and that all leads us to tomorrow's consumer price index report. Now, economists expect core CPI to come in at 3.2%, headline CPI 2.9%. Now, this is both each category a moderation from what we saw during the month of January, but still sticky prices above the Fed's 2% inflation target, and that's why economists have been pretty cautious to price in any further easing from the Fed this year. Bank of America anticipates no cuts to come. Mohamed El-Erian, he said a similar thing on our air earlier this week. That hasn't stopped markets, though, from pricing in some easing. Traders do expect about 75 basis points worth of cuts. That implies 3 cuts to come this year. That would bring the Fed funds rates down to a range between 3.5 to 3.7%. So just around here if we get those cuts. Of course, a lot of people don't think that's going to be because inflation is moderating. They think it's going to be because the jobs picture would unravel and growth would stall. So a lot riding on tomorrow's print. Josh, I'm going to send it back to you.
Thank you, Allie. For more on the state of the economy ahead of tomorrow's CPI report, we're bringing in now Betsy Stevenson, professor of public policy and economics at the University of Michigan Gerald R. Ford School. Betsy, it is great to see you. So, we have been following, Betsy, the bouncing ball of tariff headlines today. They appear to be moving the markets. As you know, I think investors are trying to think through these tariff headlines and this trade war, figure out what it could mean for the U.S. economy. Could it mean a slowdown? Could it mean even something worse? But you are the professor, Betsy. So read through us what you're thinking. How do you think these tariff threats could affect the U.S. economy going forward?
I think it's tough to read. And one of the reasons it's tough to read is because we just don't know what's going to happen. The news changes minute by minute. And, if you're trying to make investment decisions, you're trying to make hiring decisions, even if you're just trying to make consumption decisions, should you buy that new car or not right now? It would be better if you had some sense of where prices were going, and tariffs directly impact prices. So I think that uncertainty is why we're seeing a lot of volatility. That being said, every time we hear big tariffs being announced, I hope they're coming with uncertainty because I want to see the tariffs go away. So just because we had certainty doesn't mean things are going to necessarily get better. I think people really have a lot of hope that if we see that tariffs are causing the U.S. economy to slow down, then President Trump might change his behavior. I think the reason people reacted so poorly to President Trump saying, look, we could have a recession, was because what they were really hearing was, we might have a recession and I might not change my behavior, my policy, I might not change my tune on the economy. And I think there's a lot of companies, CEOs, businesses out there that just sort of expected him to follow the ball of the money so that if the economy starts weakening, he might do something different. So I think that is what has really just, put a lot of mix into chaos right now. So no one really knows exactly what's going to happen.
He did sort of say today, apparently outside the White House, he doesn't expect there to be a recession. For what that's worth, he didn't want to rule it out before, it sounds like. But Betsy, I talked to Mohamed El-Erian earlier in the week, and he sort of painted what the market seems to be perceiving as the more optimistic scenario here, which is that the administration does achieve its goals without driving the U.S. economy into recession. And one of those goals seems to be getting what they view as a fairer trade global system, right? A better deal for the U.S. Is that a worthy goal, I guess? I would ask, first of all, since you clearly don't like the tariffs, as many economists and business leaders don't, but is that a good goal to try to get to?
I'm always a little bit confused by using this word, a good deal, and then the way to get a better deal is pay higher prices. I've literally never seen anybody walk into a store before and say, this store is a terrible deal. They're charging us way too little. If they raise their prices 20%, I'll come back because it'll be a better deal. That's not what we normally think of as a good deal. A good deal usually means lower prices. So that's not what he's talking about. He's not talking about getting a good deal. What he wants to see is prices that are high enough that U.S. consumers don't want to turn to stuff made in other countries where they might be able to do it cheaper. He wants to put a little bit more fat, a little bit more cushioning in there to try to encourage U.S. companies to say, hey, you might as well build it here because you got this, you're going to have a 25% or 50% cushion. Well, the question will really be, how much are consumers willing to pay 25%, 50%, 100% more? Or how much do they just cut back what they're buying? Because if they cut back what they're buying, there's still not a huge incentive to build it here in the US because you're not going to be able to sell as much. So I think that you have to be careful. Trying to create a fully closed economy, not trading with your neighbors, is not a recipe for higher economic growth. It's a recipe for lower economic growth. I do understand that there are definitely people who've been hurt by trade that would like to see us take a little bit more of a protectionist stance. I think we should be having a discussion about those specific industries, how we're going to benefit, and how much U.S. consumers are willing to pay to give benefits to those particular industries.
Betsy, I'm curious to get your take on our labor market. We had the jobs report. I think most people looked through that report. They didn't see any, big surprises, Betsy. It seemed to sort of dovetail with that cooling, not crashing narrative we have. I'm curious what you made of the report more, and also just looking out, how you see that labor market evolving in 2025, Betsy.
Because the labor market still looks quite strong. We just got, not only news that, hiring was very good, very consistent last month. And then if we look at the job openings rate still remains pretty high. It was pretty high in January. That comes with a little bit more of a lag. We do see there's some teeny tiny cracks in there. There was some indication that some people weren't getting as many hours as they wanted, so they were part-time because they couldn't get the full-time hours. We're seeing some some small increases in unemployment insurance claims. But the reality is the labor market is strong. And I think that's why, if you look at people who are saying, look, the Fed is not going to cut rates, because what they've got to do is get inflation expectations back down. And as long as the economy remains strong, the best way to do that is trying to keep demand low. There's no reason to try to boost demand if you're trying to get people to buy less so that we can bring inflation expectations down. Right now, that seems good. We just have to keep our eye on it because the economy could cool. And I think there's a lot of reasons right now for both businesses and consumers to be building up a little bit of a nest egg. And if you're building up a little bit of a nest egg, that's a super smart thing for you to be doing as an individual. It just happens to be bad for the macro economy. If you're personally cutting back your spending to build up your nest egg, well, you're reducing consumption. That's part of our GDP. If as a business you want to wait and see what's going to happen before you make investments, that's great for you as an individual business, but that's reducing overall investment, which is a component of GDP. You put that together, and the next thing we know, we have a slowing economy. Just how slow will it go is going to depend on how big the cutbacks are that people start to make as they get more and more nervous about where the economy is going.
Yes, well, we'll track all of that data, starting with CPI tomorrow. Betsy, thank you so much. Appreciate it. Tariff fears and growth concerns have rocked technology stocks, with the tech-heavy NASDAQ declining for the past 3 weeks. Joining us now, Aaron Kessler, Seaport Research Partners, Senior Analyst. There's a little bit of bounce today, Aaron, that we got in some of these names, not universally, but we do have tech coming back a little bit today. But I guess I would ask you, first of all, big picture, you know, there is this concern seemingly about a slowing economy. How much is that potentially going to hurt big tech?
Yeah, no, we haven't really had a recession or slowing economy, obviously, in a few years here. I would say we've already discounted some of that in valuations. If you look at some of the large caps, they're off about 20% within our coverage universe, including kind of Google, Amazon, Meta. They're all down right around 20%. Our average names down about 25%. Some of the small caps are down a lot more than that. So we've already discounted, I think, a fair amount of perception of a slowing economy. And then we'll have to watch over the next kind of couple months what we actually see. We did see some headlines yesterday from the airlines seeing some slower leisure traffic in the U.S. That you've seen Airbnb down on that today, I think Booking in as well. But we'll have to watch some of these data points. Some of the companies you could actually argue could be benefit from, not to say benefit, but hold up better. I would say Amazon historically has held up pretty well in a slower environment as consumers switch to e-commerce. Maybe they don't want to drive, and so that's actually held up fairly well. Continue to see cloud businesses doing fairly well to the extent we don't get a deep recession. Still continue to expect a pretty good cloud growth over the next few years as well.
If we saw that kind of economic weakness, pronounced economic weakness, Aaron, what would it mean, for example, those big tech companies that rely a lot on a healthy ad market?
Yeah, so I think it depends on the type of advertising. Historically, we see brand advertising get hit a little bit more than performance-based. So performance-based advertising, typically it might be for a travel or an e-commerce transaction. Typically, advertisers are willing to continue to spend there as long as they're seeing good results and as long as consumers are spending. Obviously, if consumers are shopping less, they may be clicking less on a Google search result. So that could be a negative there. But historically, performance-based advertising channels, Google, Meta, have held up reasonably well. We have seen some softness. So we saw like Trade Desk this quarter, a little bit of softness. And so you can see some brand spend ease a little bit in a recessionary environment.
And let's dig into some of the specific names you cover, because take Amazon as one example. This is obviously a big complex company. It's got AWS on the one hand, but on the other hand, a big part of its business is still retail. A lot of that stuff is imported, so could be subject to tariffs. Obviously also subject to consumer spending trends. So how has it weathered these types of periods before?
Yeah, certainly Amazon's weathered them pretty well. You typically see a little bit of a trade down effect. And even over the last couple of years, as growth has slowed, as the consumer's been more tight, they've actually shifted to Amazon to look for deals more on Amazon. So if you look at Amazon relative to other traditional retailers, or they've held up fairly well. And they've seen, I would say, the growth has moderated for Amazon on e-commerce the last couple of years. On the other hand, they've been able to continue to drive nice advertising revenues. And so I think investors have to look at that as well. For Amazon, and clearly cloud growth is still growing nearly 20% for them. So it's not just a pure retail story anymore.
Aaron, any signs that the truly just incredible amounts of money these big tech companies are spending out on AI, any signs, Aaron, of that slowing down?
We haven't seen that yet. I think all the companies gave pretty hefty CapEx expectations for 2025. So something we'll watch. Obviously, there was some, with the DeepSeek news, some concern there around what that meant for CapEx budgets. But clearly, CapEx guidance was pretty aggressive still for the year. I think all the companies are working. I think I read today that Meta is working on custom chips as well for AI. So I believe all the companies will look to bring down some of these CapEx costs over time. But nothing we're hearing yet to suggest a big AI slowdown in 2025.
Generally, Aaron, when you read through the recent earnings reports from these big tech companies that you've been covering for a long time, what did you make of them? I mean, when you saw the earnings beats, were they as strong as ever? Did they get a bit weaker?
Yeah, no, for the large cap companies, still very solid results. I think probably saw some more mixed results, maybe some of the maybe the small cap companies. But historically, we've seen this quarter, large cap companies deliver pretty solid results across the board. And typically they've made some cost cuts and then more cost efficient over the last few quarters as well. So they've done a pretty good job of maintaining pretty good top line growth at the same time being more disciplined on the bottom end.
Aaron, always great to see you. Always great to have you on the show. Thank you for joining us.
Great, thank you guys.
Let's get a quick check on another beaten down Magnificent Seven stock, and that would be Tesla. That stock is jumping late in the session here, now trading near the highs of the day. Tesla CEO Elon Musk appearing outside the White House with President Trump as the president took a look at some Tesla vehicles, and he says he's planning to buy one. The president saying he hopes that if he buys a Tesla, it will help boost sales for the brand, which have come, we know, under pressure since Musk started leading the administration's cost-cutting efforts, Julie.
Yeah, the stock may be bouncing a little bit today, but as we know, as of yesterday, it had wiped out all of its gains since the election. Since the stock reached a record high back on December 17th, it has fallen by more than 50%. So, you can see on that chart, the rebound today is just a blip there because of some of the concerns. So, will Trump buying a Tesla help Tesla sales?
Dan Ives over at Redbush, bull of bulls.
Is he bullish on Tesla?
Very bullish. And here was his note today, a word of caution from Mr. Ives. He says, we believe this is a moment of truth for Musk and Tesla. If Musk continues to head down the Doge path 110% and showing no attention to Tesla during this turbulent time, then brand damage will become more pervasive. But it sounds like Musk is saying here, today, he will stay as a Trump advisor, he's saying, as long as he's useful.
Right. It's interesting because we talked to folks like Ross Gerber, who says Tesla's actually better off without Musk running it day to day. And Craig Irwin has said something similar, that, because of the leadership that's in place at Tesla, it can run itself. But then there is that brand damage piece of it.
We'll continue to watch.
We will.
Coming up, shares of Oracle, they're lower on the back of their latest earnings results. We're going to check in on some of today's top trending tickers on the other side. Stick around, much more market domination still to come.
Now time for some of today's trending tickers. Let's start with Oracle. That stock is moving lower today after reporting disappointing quarterly results and offering a sales and profit forecast for the current quarter short of estimates. Unlike some of its large cap tech peers, it is not going back into the green today, but the commentary around it is actually pretty mixed here. For one, JP Morgan said they were very impressed with the sheer raw magnitude of Oracle's bookings trajectory, but they said these are very complex AI build-outs that are posing some hurdles.
Yeah, investors underwhelmed. Sales and profit forecast for the current quarter misses. Company did emphasize its remaining performance obligations measure of bookings, $130 billion. That was around $97 billion the previous quarter. Investors are obviously not impressed today. I will say Brent Thill, Jefferies, friend of the show, smart guy, he told his clients today, looked through that report and said capacity constraints are expected to ease in the first quarter of 26, which he says should help convert RPO, again, remaining performance obligations, to revenue, drive the stock higher, maintains the buy.
Yeah, and the stock's up 26% over the past year, so we've already seen it do pretty well, though it's come down this year in this tech sell-off that we've
Larry
seen.
Ellison's done okay. He's done okay. All right, our next trending ticker. Look at Teradyne here. Those shares also getting slammed today. Stock's fallen hard, most intraday since January 2022. The semiconductor manufacturing company sees Q2 revenue looks like flat to down 10% compared to the previous quarter, Julie.
Yes, this is a semiconductor equipment maker, testing maker here. And so there was some talk about some of its testing products, particularly one called Semi-Test, that there was some volatility in that business because of the trade uncertainty that we are watching out there. So the company says there's no effect right now in the first quarter guidance, but is now saying that second quarter revenue will be flat to down 10% compared to the previous quarter. This was during its analyst day that it made these comments. The stock's already down over the past 12 months, including the
down
slump
about
that we're seeing
30%
today.
in 2025, by the way.
And finally, our next trending ticker is Hesai. The developer of LiDAR products is skyrocketing today after a report said Mercedes-Benz will develop smart driving cars for global markets equipped with Hesai's LiDAR sensors. This is the first time a foreign automaker has sought to use such Chinese-made technology for models sold outside China. So a bit of a milestone there for Hesai. This was a Reuters report talking about this Mercedes-Benz contract here. So LiDAR is basically laser-assisted radar, if you will, on some of these self-driving vehicles.
Early in the week, remember, they did announce Q4 adjusted EPS that beat, though they missed on the top line. That earnings release did say they were awarded a new groundbreaking exclusive design win with a top European OEM. They didn't say which one. Sounds like the good reports at Reuters citing sources, it's Mercedes-Benz.
Yes. Good news for Hesai today. Well, coming up, as U.S. stocks are struggling, is it time to buy internationally? We'll speak to a strategist on the other side who says to sell U.S. rips and buy non-U.S. dips. We'll have the details on that when Market Domination returns. After a sharp sell-off in U.S. stocks, European stocks are becoming the hottest trade on Wall Street. And our next guest says to sell U.S. rips and buy non-U.S. dips. We're navigating how to play the European markets with the Yahoo Finance playbook. Joining us now, Jay Pulaski, TPW Advisory founder. Jay, it's good to see you. I like that line so much, the rips and dips line. But, you know, it's almost coming around to consensus now that a lot of folks are looking at Europe versus the backdrop of what we're seeing in the U.S. Just first of all, I guess, level set here, lay out for folks why Europe is so attractive right now.
Well, to help level set, Julia, and it's great to see you, I would just say that last week was the best week ever for developed markets ex-U.S. or EFA, as it's known in the industry, versus the S&P. So relative outperformance. And I think that really tells you something, right? Because typically, traditionally, and certainly over the last, 10 or 15 years, when the U.S. has been the dominant lead equity market, when the U.S., caught cold, the rest of the world really sneezed. And last week, the U.S. caught cold, and the rest of the world sailed on unperturbed. And so, look, I really think basically the bottom line is that we have great uncertainty in the U.S., self-imposed uncertainty by the White House. Markets hate uncertainty. That's just a given. And the president and the Treasury Secretary were both given the chance to say that there's not going to be a recession late last week and over the weekend, and both refused to do so. And that helps explain yesterday in the first part of today, right? I mean, it's all about earnings for the U.S. market. There's no room for multiple expansion. The U.S. is priced for exceptionalism. Exceptionalism is over, and it's over for two reasons, right? One is that the fiscal stimulus in the U.S., the fiscal bullet, has been shot post-COVID, and that drove our exceptional growth vis-a-vis the rest of the developed world, which led to big capital inflows, led to premium pricing, and led to the idea of American exceptionalism, Mag 7, et cetera. The second factor was the announcement of DeepSeek, the Chinese AI company, and that really shot a hole, in our view, in the heart of American exceptionalism, which is the big cap tech stocks. And we've seen that playing out here basically since DeepSeek was announced. The trade out of US Mag 7 into China tech, which we use KWEB, the ETF, for that purpose, has been as clean and as clear a rotation from one sector in one country to another that I think I've ever seen in my 35 plus years of experience. And so what's happened is that the U.S. has shot its fiscal bullet, and Europe and Asia are about to shoot theirs vis-a-vis German rearmament, European rearmament, and China consumption. And that's really what markets are paying attention to.
So Jay, what about tariff headlines, the trade tensions, the policy uncertainty? If I'm a viewer right now and I'm interested in putting money to work in Europe, how should I be thinking through those dynamics?
Well, we wrote a piece, Josh, about a month ago now called The Stoic Strategy, and how to invest in the age of Trump. And basically, we went back to the idea that you imagine everything and fear nothing. right? That's a Stoic, one of the key principles of Stoicism. You imagine everything. Everything's on the table. And I think that really applies because President Trump in his second term is unbounded by virtually any guardrail that existed in the first term. And so, he's kind of playing with house money, and they are determined, they being the administration, to upset the apple cart, both in terms of foreign policy in the Ukraine, switching sides from the Ukraine to Russia, as well as in the economic sphere, talking about needing to detox, needing a transition. Detox is not painless. Detox is actually painful. And so I was really surprised by that choice of terms by the Treasury Secretary, who as a market guy, you would think would know how that would be taken by the market. Nonetheless, I think that tariffs are fully priced in. If you look at China, again, China's leading. KWEB, which I mentioned, up 25% year to date. Big cap China tech, big cap China stocks up 20%. Europe up 12%. The market is not worried about tariffs as much as folks think it is because it's already been fully priced in. It's been talked about for months. It's not a surprise.
So if tariffs are fully priced in, is it also too late to get in on Europe, for example? I know that you're looking at the financials over there. You're looking at defense stocks, which have had a monster move upward. Is it too late to get in on those moves?
Well, that's why we said sell U.S. RIPs and buy non-U.S. dips, right, Julie? Because the idea in our view is that we are at the beginning of a secular change in global equity leadership away from the United States, which has been the dominant market since the great financial crisis bottomed 15 plus years ago, to the rest of the world as this fiscal stimulus process switches from the U.S. to the rest of the world. And so the bull market is globalizing to non-U.S. leadership. And by the way, the bond bear market, which we've had in the United States, is also globalizing. And that's why you see rates backing up in Europe, in Japan, in China. It's the same playbook. It's just moved outside the U.S. And so we believe this is a secular move. We think it's going to last not months, not quarters, but years, multiple years. And so, no, it's definitely not too late. If you have a long-term view, which I think investors really must have in this environment, unless you want to try and day trade this action, which, good luck to you. Here at TPW Advisory, we don't do that. We're long-term thematic investors. And so on that basis, any pullback in Europe should be bought because the investment spending that is going on, and we just heard about potential ceasefire in Ukraine. If there is a permanent ceasefire in Ukraine, that just adds the reconstruction of that country will be extremely beneficial to the infrastructure sector in Europe, which is already benefiting from tremendous spending that's going to come down the pike over the next 3 to 5 years in defense and in AI. And so our view continues to be that we're in a tripolar world, regional deepening and integration in Europe and in Asia. Spending in AI, climate, and defense is going to underpin global growth, which in turn underpins the global equity market through the earnings channel.
And Jay, what are your expectations for the ECB? I'm just curious how, if at all, that plays into your outlook for the region.
No, it really doesn't, Josh. I mean, we've switched, right? Our focus has not been for quite some time on monetary policy. The game is fiscal policy. AI, climate, defense, infrastructure, these are existential issues that need to be addressed and are being addressed in Europe because they must. Germany is making its moves because it needs to avert stagnation. China is making its moves because it needs to avert deflation. President Trump is accelerating and deepening their moves with his actions in the conflict in Europe. And so in the piling on tariffs in China. So its monetary policy is not really a factor. What is a factor is fiscal spending, which means higher interest rates, long duration bear markets in, as I said, Europe, Japan, China, et cetera, which should strengthen the currencies. And another factor that we're paying a lot of attention to right now is our view that we're in the very beginning of a significant period of capital repatriation out of the United States back into the rest of the world to help fund some of the expense and the buildup that we just talked about in terms of the investments needed in Europe and in Asia. So for us, the dollar is the tell. The dollar's down, 6% year to date, give or take, and we think it could go considerably lower over the next couple of years, providing a tailwind to non-U.S. equity outperformance.
Jay, great to have you on the show today. Thanks for taking the time to chat. Appreciate it.
Thank you, Josh. Thanks, Julie.
And while we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.